Right now, as you are reading this, there are millions of Americans over the age of 60 who are sitting on a financial time bomb inside their own checking accounts, and they have absolutely no idea it is ticking. We are talking about a rule change from the IRS that went into effect in 2026 that could cost the average retiree anywhere from $12,000 to over $40,000 in unnecessary taxes and penalties if they do not take action. And here is what makes this so frustrating. The people getting hurt the most are not careless spenders or bad planners. They are diligent, hardworking Americans who did everything right. They saved, they followed the rules, and now, because of one change they never heard about, they are quietly losing money every single month. If you are between the ages of 55 and 75, and you have a checking account, a savings account, or any kind of retirement account that feeds into your bank, you need to stay with me for the next few minutes. What you're about to hear could genuinely protect your financial future. Welcome to Retire Mentor, the channel built for people just like you who want straight talk, real answers, and zero financial jargon. If you have not already subscribed, I want to ask you to do that right now. Just hit the subscribe button below this video. We put out new retirement guidance every single week, and with rules changing as fast as they are in 2026, you cannot afford to miss a single update. Subscribing takes 2 seconds, and it could save you thousands of dollars down the road. Now let us get into the heart of this. The rule change we are talking about today involves required minimum distributions. Most people call them RMDs. And before you say you already know about RMDs, I want you to stick with me here because what the IRS quietly updated at the start of 2026 goes way beyond the basics that most retirement videos cover. This is not your standard explainer. This is about a specific shift that affects when you must take your distributions, how much the IRS now expects you to take, and Rakshal, most critically, what happens to your checking account and your overall tax picture when you get it wrong. Let me introduce you to Gary. Gary is 68 years old, retired 3 years ago after 31 years as a high school history teacher in Columbus, Ohio. He has a pension that covers most of his living expenses, plus a traditional IRA he built up on the side over the decades. Gary is smart, Gary is organized, and Gary thought he had his RMDs completely handled. He had set up automatic distributions from his IRA to go straight into his checking account every January. His financial advisor set that up for him years ago, and Gary figured it was basically on autopilot. Here's the problem. The IRS updated the Uniform Lifetime Table again in 2026, and that updated table changed the life expectancy factors they use to calculate how much Gary is required to withdraw each year. Gary did not know. His automatic withdrawal was still pulling out the old amount, which, as of January 2026, was now below his new required minimum. That difference, small as it sounds, put Gary in penalty territory. The IRS charges a 25% penalty on the amount you should have withdrawn, but did not. On a gap of just $3,000, that is $750 gone. Just like that. And Gary had no idea until he got a notice in the mail. Now, here is where it gets really interesting because Gary's situation is not unique. According to data analyzed from IRS filings in recent years, it is estimated that hundreds of thousands of retirees every single year underpay their RMDs, not out of greed or negligence, but simply because they were working off outdated information. The 2026 update to the life expectancy tables follows the original Secure Act changes and the follow-up Secure 2.0 Act, and together these laws have reshuffled the RMD landscape in ways that a lot of retirees have not caught up to yet. So let us make sure you understand what the current rules actually say. As of 2026, if you were born between 1951 and 1959, your required beginning date for RMDs is April 1st of the year after you turn 73. If you were born in 1960 or later, that age bumps all the way up to 75. That is a significant change from the old age 70 and a half rule that people followed for decades. And for many retirees who have been holding off, thinking they have more time, there is an important nuance. Waiting until the very last moment can actually create a double distribution year that throws your entire tax bracket off. Now pay close attention here because this one is a big deal. When you delay taking your first RMD all the way to April 1st of the following year, which the IRS permits, you still have to take your second RMD by December 31st of that same year. So in a single calendar year, you could have 2 full required distributions hitting your income at once. Both of those land on your tax return. both get counted as ordinary income, and if you are receiving Social Security, both of them could push you into a bracket where more of your Social Security benefits become taxable. That is a double hit most people never see coming until their tax preparer delivers the bad news in April. Meet Margaret. Margaret is 63 years old, widowed 5 years ago, and manages her finances entirely on her own. She has a rollover IRA that her late husband had contributed to for over 2 decades, as well as a small brokerage account. Margaret had heard of RMDs but figured she did not need to worry about them yet since she was not close to 70. What she did not realize is that inheriting an IRA from a spouse changes the rules significantly. As a spousal beneficiary, Margaret had the option to treat the IRA as her own, which she wisely did. But what her bank never told her, and what the IRS does not exactly shout from the rooftops, is that once she made that election, her own RMD start date clock began ticking. She needed to make sure her beneficiary designations on that account were updated because the Secure 2.0 Act changed some of the rules around inherited IRA distributions for non-spousal beneficiaries going forward. The estate planning implications of not having that paperwork updated properly could leave her heirs in a tough spot down the road. Margaret's story brings us to something that surprises people the most, and that is the connection between your checking account and your tax withholding on RMDs. When your IRA custodian sends your required distribution to your checking account, they typically withhold 10% for federal taxes by default. That might sound reasonable. But here is the issue. If your total income, including Social Security, pension payments, and your RMD, puts you in a higher bracket, that 10% withholding may not be nearly enough. You could owe the IRS a significant amount at tax time, plus underpayment penalties on top of that. The IRS expects taxes to be paid throughout the year, not just in April. So if your withholding is too low, you are potentially looking at both a surprise tax bill and a penalty for underpaying. The fix is straightforward once you know about it. You can file a new form with your IRA custodian, specifically IRS Form W-4PI, to increase your voluntary withholding percentage. Some retirees choose to withhold 15, 20, even 25% depending on their overall income picture. Doing that one thing alone can prevent a very unpleasant April surprise. Now let me bring in Dennis. Dennis is 67 years old, still working part-time as a consultant after 38 years in manufacturing. He has both a traditional 401k from his old company and a Roth IRA he opened about 12 years ago. Dennis has been told by two different people that he does not need to worry about RMDs from his Roth IRA. And those people are correct. Roth IRAs do not have required minimum distributions for the original account owner. That is one of the most powerful benefits of a Roth. But here is where Dennis almost made a costly mistake. His old company 401k is still sitting there from his previous employer. And unlike a Roth IRA, traditional 401k plans do have RMD rules. Dennis had assumed that because he was still working, he could postpone RMDs from all his accounts indefinitely. That is not quite right. The still working exception only applies to your current employer's 401k plan, and only if the plan document specifically allows it. His old company's plan? That is a different story. That account follows the standard RMD schedule based on his age. Dennis avoided a penalty only because he caught this in time and rolled that old 401k into his own traditional IRA. That consolidation move also simplified his paperwork, gave him more investment flexibility, and meant he was only dealing with one set of RMD calculations instead of two. If you have an old employer retirement account sitting somewhere that you have not touched in years, Dennis's story should get your attention fast. Here is the part that nobody talks about, and I want you to really hear this because it applies to a huge number of the people watching right now. The standard advice people give about RMDs is always centered on the minimums. Take the minimum. Do not take more than you have to. Keep your taxes low, and that advice makes sense on the surface. But for some retirees, strategically taking more than the minimum, especially in years when your income is lower, can actually be one of the smartest tax moves available to you. It is called a Roth conversion strategy, and in 2026 it is more relevant than ever. Here is how it works in plain English. If you are in a year where your total income is relatively modest, Maybe you are not taking Social Security yet, or your pension is smaller than expected. You might have room in your current tax bracket to pull out additional money from your traditional IRA above and beyond your RMD and convert it to a Roth IRA. You pay the tax now, at today's rates, in your lower income year. And from that point forward, that money grows completely tax-free, and you will never owe RMDs on it again. For Gary, for Margaret, for Dennis, and potentially for you, this kind of strategic partial conversion can reduce the total lifetime tax bill by a meaningful amount. We are talking tens of thousands of dollars in some cases. The key is understanding what your effective tax rate looks like right now versus what it might look like in the future when RMDs are potentially larger. A qualified tax advisor can model this out for you, and the result can be genuinely eye-opening. Now let us talk about the checking account piece specifically, because I know that is a big part of why you clicked on this video. A lot of retirees, including Gary, use their checking account as the landing spot for all their retirement income streams. Pension, Social Security, RMDs, it all flows into one account. That is totally fine and very common. But there are a few things about that setup that can quietly create problems if you are not watching carefully. First, when multiple income streams land in one place, it becomes easy to lose track of what came from where. That matters because the IRS treats different sources of income differently. Your Social Security may or may not be taxable depending on your combined income. Your RMD is always taxable as ordinary income unless it came from a Roth account. Your pension may or may not have already had taxes withheld at source. When all of that mixes together in your checking account, things can get blurry. A simple solution is to keep a monthly income log, even just a basic spreadsheet or a notepad, that tracks exactly what arrived, where it came from, and how much, if any, was withheld for taxes. This one habit alone can save you enormous headaches come tax season. Second, and this connects back to what happened with Gary, if your RMD is set up as an automatic transfer, you absolutely need to verify that amount at least once a year, ideally every December. Call your IRA custodian, log into your account online, or ask your financial advisor to confirm that your automatic distribution amount has been recalculated using the most current life expectancy tables. Because as we saw, the IRS updated those tables again in 2026, and if your custodian has not automatically updated your calculation, you could be silently under withdrawing without any alarm going off. Third, and Margaret found this out the hard way, make sure that every account you own, especially your IRAs and any leftover employer retirement accounts, has an updated beneficiary designation on file. This is not just about estate planning for the future. It can affect how RMDs are calculated today, depending on the age difference between you and your named beneficiary. If you named your spouse as your primary beneficiary and there is more than a 10-year age gap, you may actually qualify to use a different, more favorable life expectancy table that results in smaller required withdrawals each year. But only if the designation is on file and up to date. A stale beneficiary form could mean you are using the wrong table entirely. This next point is where I see people leave serious money on the table, the qualified charitable distribution. If you are 70 and a half or older, and note that the qualified charitable distribution age threshold has not changed, even though the RMD starting age has, you are eligible to direct up to $100,000 per year directly from your IRA to a qualified charity. That distribution still counts toward your RMD requirement for the year, but it is completely excluded from your taxable income. You never see it as income. It does not push up your adjusted gross income. It does not affect how much of your Social Security gets taxed. It does not push you into a higher Medicare premium bracket. If you are charitable inclined and you are old enough to qualify, this strategy is one of the single most powerful tools available to a retiree. Yet, based on surveys of retirees in recent years, the overwhelming majority of those who would qualify have either never heard of it or have heard of it but assume it is complicated. It is not complicated. You simply instruct your IRA custodian to send the funds directly to the charity. The charity must be a qualifying 501c3 organization. The check cannot pass through your hands first, and you request written acknowledgement from the charity just as you would for any donation. Dennis actually used this strategy last year. He had a small amount of his RMD from the old employer account before he did the rollover, and he directed $3,000 of it to his church's food pantry program. That $3,000 was excluded from his taxable income entirely. His Social Security taxation calculation was lower because of it. His Medicare premium tier stayed the same. For Dennis, it was a triple win. And wait until you hear this one because it trips up even the most financially savvy retirees. This involves what happens when you have multiple IRAs. A lot of people over the course of their working lives end up with more than one traditional IRA. Maybe you rolled over a 401k somewhere along the way. Maybe you opened a new one at a different institution when rates were better. Whatever the reason, multiple IRAs are very common. Here's the rule. You must calculate your RMD separately for each IRA that you own. But, and this is the part that trips people up, you do not have to take the distribution from each individual account. You can aggregate the total RMD amount across all your traditional IRAs and take the entire sum from just one of them if you want. This gives you flexibility to strategically withdraw from whichever account makes the most sense for your investment mix. However, this aggregation rule does not extend to 401k plans. If you have multiple 401k accounts, each one requires its own separate RMD withdrawal. You cannot aggregate across plan types. So if Dennis had kept that old employer 401k alongside his current one, he would have needed to take two separate withdrawals. Another good reason to consolidate when it makes sense. Let me come back to Gary one more time because his story has a genuinely encouraging ending. After he received that IRS notice, Gary sat down and did a thorough review of everything. He updated his automatic withdrawal to match the new 2026 life expectancy table. He filed an amended tax return using the IRS reasonable cause exception, which under IRS Revenue Procedure 2020 does, carried forward and still applicable in 2026, allows a penalty waiver for a first-time good faith mistake under certain conditions. He spoke to a CPA who helped him set up the right withholding going forward. And he started keeping that simple monthly income log we talked about. Gary told me it was one of the best things that ever happened to him financially, not because getting a penalty notice is fun, but because it forced him to understand his own retirement picture in a way he never had before. Today, Gary has a clear plan, a lower tax burden going forward thanks to some Roth conversions in years where his income was lower, and real confidence in where he stands. That is what this channel is about. Not fear, not confusion, real practical knowledge that you can actually use. So let me pull together the key things you need to do right now, today, this week. If you are already past your RMD starting age, contact your IRA custodian and confirm that your distribution amount has been recalculated using the updated 2026 Uniform Lifetime Table. If you have an automatic withdrawal set up, do not assume it is correct. Verify it. If you are approaching your RMD starting age, meaning you are in your early to mid-60s, now is the time to model out the potential impact of strategic Roth conversions before those mandatory distributions begin. The window for smart pre-RMD conversions is one of the most valuable and underused opportunities in all of retirement planning. Check your beneficiary designations on every retirement account you own, not just your IRA, but your 401k, your 403b, your 457I, any account that has a designated beneficiary field. This takes 30 minutes, costs nothing, and could have significant tax implications for both you and your family. Update your federal withholding on RMD distributions using Form W-4P. Do not let the default 10% be your entire plan. And if you are 70 and a half or older and you have any charitable giving in your life, talk to your CPA about whether qualified charitable distributions should be part of your 2026 strategy. Margaret spent one afternoon this past spring doing exactly these things. She updated her beneficiary designations. She increased her withholding. She confirmed that her IRA was now properly titled in her own name following the spousal rollover. And she made an appointment with a fee-only fiduciary advisor to look at whether Roth conversions made sense for her particular situation. She went from feeling overwhelmed and uncertain to feeling genuinely in control of her financial future. That shift does not require a finance degree. It just requires the right information, which you now have. If this video helped you see something you had not thought about before, I want to ask you to do one simple thing. Share this video with someone you care about. A spouse, a sibling, a friend from your old workplace, anyone in that 55 to 75 age range who might be sitting on one of these issues without knowing it. Retirement is supposed to be the chapter you worked your whole life for. A video like this one, forwarded at the right moment, could genuinely save someone thousands of dollars and a whole lot of stress. And before you go, drop a comment below and tell me which part of this surprised you the most. Was it the double distribution year trap, the updated life expectancy tables, the qualified charitable distribution strategy? Or maybe you have your own story, something you learned the hard way, or a tip that saved you money. This community learns from each other, and your comment might be exactly what someone else needed to read today. Thank you so much for spending this time with Retire Mentor. This channel exists because of viewers like you who take their retirement seriously and want to stay informed. Please remember this video is for educational purposes only. For your personal situation, always consult a licensed financial advisor or contact Social Security directly at ssa.gov.